Good afternoon, everyone. It is March 9th, 2021. And as usual, we just want to thank all of our viewers and listeners for attending just another Life Pro Asset Management weekly market update. And it's an important one. We're going through a stock market correction. We're going through a growth correction as it relates to our investment strategies. And one of the things that we know with absolute fact is that what we do during stock market corrections, what we do during investment style corrections, ultimately determines our long-term investment success. We know that stock market corrections are painful. We know that they can question our overall thesis in many cases. But what we also know is that they're the greatest moments of opportunity. And when we look at the difference between investment strategies that outperform over the long term versus those that underperform the market, it's what they do during corrections. Do the portfolio managers get scared and try to mitigate so-called risk and raise cash right at the bottom, or do they actually reposition the portfolios and optimize those portfolios for the ensuing recovery? So these are the points that we're going to go over today. I got my analyst here, Tim Devlin. Tim, say hi to the crowd.
Hey, nice to be here again.
Awesome. And, we're going to go over all of those points, ladies and gentlemen, because it's important. And one of the great things is that despite the pullback, our 1 year numbers are still over 107% after fees. And for a lot of the clients that are experiencing those returns, they're experiencing that success because of how they navigated March of last year or December of 2018. So let's go ahead, Tim, and get started. I'm going to go ahead and I'm going to share my screen here with everyone. And we're labeling this week's theme, navigating the recovery, because what we saw were the lows try to be put in there around Friday mid-morning of last week, and now we're starting this recovery process. Now we're going to show what that recovery looks like on the chart, but the reason why we call it navigating the recovery is that in many cases a lot of clients and professional investors alike can make mistakes during the sell-off, but they can also make mistakes during the recovery, right? So after that bounce, they say, okay, this is my time to get out and sit out for 2 weeks and then get back in, or that disbelief that the market is actually recovering. And so we want to dispel a lot of those beliefs that can really hurt us during the recovery. Believe it or not, the recovery in many cases is what hurts investors more than anything else. So we're going to go through that process of how we can effectively navigate the ensuing recovery here after the correction. Secondly, we want to question what inning of the 20-year secular bull market are we in? As many of our viewers and listeners know, that our work suggests that in 2009 we began the birth of a new 20-year secular bull market that ended the 10-year secular bear market that dominated the economy from 2000 to 2009, 2010. Lastly, we want to stay focused on durable, high quality growth, right? We don't want to chase junk. We don't want to go in for a 2-week trade in areas of the economy or the types of businesses that are rental stocks versus ownership stocks. We are owners, we're not renters. And that is a key theme when we think of how do we invest for the long term? How do we invest for success? We want to own, we don't want to rent. Renters ultimately pay performance tax, as we call it. Now, real quick here, year to date, we are down about 6.55%. We are working through that recovery, that correction. And now the first parts of the recovery that really started in mid-February there. And you know what? That's okay. This happens. We experienced corrections back in December of last year, September of last year, right before the election, and certainly March during the COVID shutdowns, and then December 2018, which we're going to go over each of those drawdown periods to see how it impacted performance for those investors just before the correction and just after the correction. Now, here's the key stat that everyone needs to follow is the 1-year number. Now, Tim, when we look at the Morningstar results, what is second place? And so if you look at the number of growth strategies with one that are leading the 1-year return number, what would second place be around right now? I think it's just below 70%, correct?
Yeah, so when we looked at it yesterday, it was right around 70% for second place, and then it drops off, somewhat dramatically. But this morning when I took a look at it, I think the next closest one was right around 91%. So 16% below our 1-year number as of today.
And that's a great point, Tim. So over 1 year, our investors have been able to generate 107.93% returns after fees. This is key. And the reason why we've been able to do that is, part of it's stock selection, but for the most part, it's how we do navigate these pullbacks, right? Is to make sure that as the market is pulling back, are the themes intact? Are the companies intact? And our management teams continuing to build that value line upward and to the right? These are key points that we don't want to let the noise of the media, the noise of the market over the very short term to distract us from our long-term goals. Since inception, we are up 206.16%, generating outperformance versus the stock market, otherwise the S&P 500, of 133.06% after fees. Now, this is key. We wanted to make sure we wanted to not just disclose performance here over the very short term and what that stock market correction and more specifically that style correction as it relates to the growth area of the market has looked like so far, but we also wanted to walk clients and advisors through what has our strategy typically done in terms of corrections, in terms of drawdowns. Now, if we look at this chart here on the left, 10% corrections happen quite a bit with our strategy. We know just in the last year, we've had 1, 2, 3, 4, 5, almost 5 corrections of 10% or more. That's normal. That's what generates that performance over the long term. Now, how many corrections have we had over the last 3 years that are 15% or more? Well, we've had 3. We had in at the end of 2018, so basically Q4 of 2018, we had a 26% drawdown. And then we had a drawdown of around 35% in March of last year. And then this year, if Friday ultimately proves to be the bottom of this correction, last Friday that is, then that would have amounted to about a 21% drawdown. And right now we're sitting around a 16% drawdown. Now, Tim, you did a great analysis here. When we look at the boxes on the right, what is the return data telling us for those clients that invested the day before the correction started?
Yeah, so if we look at clients that invested 1 day before the drawdown began across those time periods, one thing you'll notice is that percent return on the right. The farther or the longer they've been with us, that greater that percent return is. And I think it really speaks to something that we talk about internally. And Rob and I talked about it just the other day. You have to be making higher lows over time, right? You have to be making value up and to the right. As you always mention, it's important that when these drawdowns happen, you're recovering, but you're also gaining after the fact, right? And so we can see that with our clients over time.
Yeah, those are great points, Tim. And when we look at the boxes on the right, ladies and gentlemen, I wanted to go through the big corrections, right, that we've had with our strategy, because 10% corrections are going to happen every few months. And even if you've been with us since September, you've experienced 3 of them. But the the big corrections would have been in Q4 of 2018. So if you invested right before that 26% drawdown in the market, right? So right here, line number, the second line right here, the extent of the drawdown, 26.56%. So you invest with us, and right away we deliver 26% losses. Obviously a terrible look, but where are those investors today? Those investors today, even after this drawdown, right? So they invested right before the 26% drawdown in 2018, and they've stomached the recent correction. Those investors are up 111.70%, even though their timing was terrible as it relates to when they got into the market and our strategies specifically. Secondly, the other big drawdown was, of course, the COVID shutdown. That actually started February 19th of 2020. That was when we started to see COVID spread throughout Italy and the European continent. And the market sniffed it out that, hey, it was just a matter of time before it reaches the US. That was a 36% drawdown. So what happened to those investors that invested basically on February 18th? By no luck of their own, for sure. They invested February 18th. They rode that entire 36% drawdown throughout the COVID shutdown. Where are they today? So when we look at that drawdown and what the ensuing return is, you see the returns are actually pretty good. They're up 67.71% since February 18th of 2020. And that's with a 36% drawdown. So the message here, ladies and gentlemen, is that over the very, very short term, your timing can be lucky, your timing can be unlucky. But over time, what we've seen with almost all of our clients is that we've been able to generate very, very significant returns after fees, and more specifically, outperformance versus the stock market. And why is that? Because over the long term, the stock market is a weighing machine. It doesn't care about the noise of the media. It doesn't care about the 2-week pop in interest rates or the inflation scare or COVID. What it cares about is what are companies doing, and what are the companies that are generating sustainable and high quality long-term growth? Who are the leaders leading that space? And ultimately, that's where the value ultimately accrues to. It's hard, and we got to go through these pullbacks, but that's what makes for investment success. So if we go back real quick, this 206% return, this 107% return, it's composed of companies that are leading positive disruptive change with safe balance sheets, high growth rates, and low levels of debt and high free cash flow. That's what we're going to stick to. You're never going to see us chase junk. The other thing here is, this is another great chart that Tim put together here. Actually, I think Tim sourced it to be more specific from Wall Street Journal.
Can't take credit for this one.
Exactly. But I think it's a very powerful chart, ladies and gentlemen. One of the things that we often hear from investors, and not just at our firm, but just in the media and whatnot, is I'm just going to go to cash for the next 2 weeks, and then I'm going to get back in. Does that sound familiar? I'm sure a lot of people watching this video have had that thought in their head in the past, right? Anytime we have a market correction, it's certainly a tempting strategy. Well, let me just go to cash for 2 weeks and then I'll come back. Tim, what happens when clients do that?
They miss out on the best days. And so what this chart really shows is those top best days in the S&P 500. And one of the things that I think is really interesting about this is it happens right after big drawdowns, right? So we talked about it a little bit last week. We alluded to the fact that oftentimes the recovery is very sharp as well. And you can see that in the data, right? And I even looked at our own data with the opportunity strategy, and our strategy bottomed about March 18th of 2020. And 3 of our best days came within a week after that. 4 of our best days came within 3 weeks, and then 5 of our best days came a month after that, right? So had you been in cash, waited till the market got better, you missed out on 5 of the best days, going forward.
And what's
So
the
go ahead.
long-term impact, Tim, of missing just 10 days of those big recoveries?
Yeah, so you can see on this chart here, what they did is they showed the impact of missing those best 10 days. And it equates to about, $23,000 almost.
So if
which
you
is
invested
huge.
$10,000 in 2001, correct? So that's based on an
Correct.
investor that if they invested 10,000 in the market, not our strategies, ladies and gentlemen, just the S&P 500, you basically would your returns are 50% less, correct, Tim?
Yeah, exactly.
Now, some investors may push back and they may say, well, I'm okay. I still grew from 10,000 to 19,000 and I kind of let myself sleep at night. And yeah, it would have been nice to have 42,000, but Tim, maybe explain and coach clients and advisors why the difference between 42,000 and 19,000 is not just that being able to sleep at night, but what is the impact to the longevity of someone's wealth that is essentially not realizing the full potential of the market?
Yeah, so the biggest impact is really it eliminates your ability to compound money over time, right? So when we think about someone entering retirement, somebody in retirement, they're going to start withdrawing their money, right? So if they're earning a lower rate of return, they're also withdrawing. That money that they have in their portfolio is not going to compound as much. It's actually going to lessen the lifetime value of that portfolio. In other words, you're going to run out of money quicker, right? You might run out of money
Absolutely.
by 80 instead of 90. And that 10-year difference is huge.
Absolutely, Tim. So there's two big takeaways here. First, behavioral investing, coaching ourselves to stomach volatility, coaching ourselves to ignore the media extends the life of our investment savings in retirement. That's the first leg. The second leg is active management, if done successfully and generates sustainable long-term outperformance versus the market, adds an additional layer of years to longevity of your savings. That's the key message here. And then the third, I know I said there was only two, but there's really three, is please, ladies and gentlemen, ignore the media. The media needs to generate eyeballs. We invest in media companies. We know how that works. You need to sell ads, and fear sells. We're going to walk through how the whole inflation scare was a mirage. And we saw with the inflation data today, there is no inflation. And so we're going to go through that, but this is really the key message, right? Is behavioral investing, active management if done correctly, and thirdly, really at the end of the day, being able to ignore outside people chirping into our ears are what are the three core pillars that add life to our retirement savings over the long run. So what are the key questions to ask right now as we're going through the stock market correction? I came up with this phrase here: nostalgia makes for great memories and conversations, and for awful long-term investment results. What's the point of that phrase, ladies and gentlemen? We love to sit down around the dinner table or over a couple of drinks and kind of go back and talk about yesteryear and talk about all the experiences that we had with our friends, the good, the bad, the ugly, and we laugh about it, right? In investing, nostalgia is not an investment strategy. What I really mean by that is technology doesn't go backwards. We don't suddenly say, you know what, we're not going to use LED TVs anymore. We're going to go back to tube TVs. Or, you know what, the e-commerce is too convenient and too cheap. Let's go back to the oligopoly of department stores where they add premium pricing for the same objects or for the same merchandise. That's not what happens. And so what we need to do is when we hear about this so-called value rotation, or we hear about this so-called the cyclical stocks versus the secular growth stocks. Go back and let's ask ourselves some core questions. Are we no longer going to shop online? And are we going to shop online less or more over the next couple of years? If the answer is yes, we are going to shop online. Yes, we're going to do more and more activities online. And yes, we're going to do it more than we did last year. Then don't worry about those e-commerce platforms. They're going to do just fine. Trust me. Secondly, will the global economy retreat from digitization? The economy is reopening from COVID. So we're no longer going to implement digital processes into how we do things on a day-to-day basis. We're going to go back to a non-digital world. If that sounds ludicrous, then I think we're going to be okay because we invest in digitization leaders. Third, is the need for cloud-based computing and digital security dead? We're going to reopen. So we're going to do everything face-to-face, and we're no longer going to use computers. We're no longer going to utilize cloud-based software and computing platforms, and we no longer need to secure our online workloads. If that sounds ridiculous, we're going to be just fine. Will millennials begin to use their parents' brands? I think we all know the answer to that. I know my wife, and she loves her mom and everything, but she's certainly not going to shop at the same store. We're not going to eat at the same restaurants. The millennials are entering their prime spending years. They have certain lifestyles and brands that they love and they espouse, and that's going to continue to grow. That's not going backwards. If you believe that statement, we're going to be just fine. And when we look at the names that we're investing in, they're leaders in all of these categories. They're not the number 7, number 8, or the dirt bag small cap companies. They're the large cap leaders that are leading innovation, they're leading disruption, and they're market share leaders. So that's really, at the end of the day, when you go through stock market corrections, it's always good to ask these questions. And then I think that's what really, at the end of the day, gives us such high levels of confidence in terms of not just the performance we've generated in the past, but how do we deliver and execute on growth over the next 12 months, right? That's the key. It's great that our clients experience 100% growth year over year, but we need to deliver growth over the next 12 months and the 12 months after that. That's key. That's what investing's all about. Because if we can't generate growth going forward, then what's the point, right? But the good news is when we look at those companies, they are primed for many, many years of durable, above average growth. Now, this slide, ladies and gentlemen, is labeled History Often Rhymes. We talked about that 20-year secular bull cycle. One of the biggest pushbacks that we get with just the bull market in general is that, well, it's been going on since 2009. That was the biggest mistake that a lot of people made, ladies and gentlemen, in the late 1980s. In the late 1980s, many people thought that the bull market had been going on for 9 years and that it was due to end. But here's the problem with that narrative, is that secular bull markets, when we go all the way back to the 1890s, secular bull markets tend to run around 20 years with a 10-year secular bear market as the interlude between the next 20-year secular bull market. Why 20 years? Who knows? They tend to last around 20 years. So if we look back, there's been 3 key secular bull cycles really over the last 70 to 80 years. The first was born in 1942. We're labeling that American supremacy. 1942 is a key date, ladies and gentlemen. The Battle of Midway was the turning point of World War II. And ensuing to that was the bottom of the stock market. The market knew, investors knew, that America was going to win World War II and that America would emerge as the new global superpower in the post-war order. That's very, very key. That unleashed the next 20-year secular bull market that was defined by American exceptionalism and American leadership on the global stage. Then we had the 1970s, and we all know stagflation, right? We had many, many years of built up capacity, and we had many years of debt building up in the system. And then we had inflation, and we had about 10 years of that. And America was struggling in its war against inflation until Paul Volcker, the Federal Reserve Chairman, had the guts to dramatically increase interest rates, to basically go nuclear on inflation. 1982 was the birth of the new secular bull market that most of us grew up during, or were during our prime spending and saving years, was 1982 to 2000. The defeat of inflation that unleashed 18 years of unabashed growth in the stock market, interluded by the 1987 crash. That 1987 crash, ladies and gentlemen, very, very similar in timing and in terms of the nature of that crash, really 1 week in nature before a sharp recovery of the COVID crash. So for us, 1987 is equivalent to that COVID crash. 2009, American resurgence and the defeat of deflation. Reflation and the emergence of American productivity and technological prowess and innovation is what is defining this 2009 to what we believe, based on our research, to 2030 secular bull market. It's exciting. We're gonna have some pullbacks. 1987 moment was last year in 2020, but now we're in the second leg of this secular bull market. This is how wealth is ultimately created. Now, does that mean we can't have corrections? Of course not. We're going to. Since September, we've had 4, right? That's okay. And when we look at right now in the very, very short term, ladies and gentlemen, there's a few charts I want to go over here. So the overall correction started, as we all know, with interest rates popping, the fear of inflation. Higher interest rates will have this devastating impact on companies that realize a lot of long-term growth. It's a very cute narrative. It's an interesting narrative, but it's just not reality, ladies and gentlemen. So when we look at really what's happening here at the NASDAQ, is we're having a correction within a very strong long-term uptrend. We've tested the 200-day many, many times throughout the last decade, and we did it again. And that's simply what happened. Sometimes the market just needs an excuse to take a breather, catch its breath, restore its energy before resuming its uptrend. In this case, it was the NASDAQ that was at the center of the storm, and a lot of the secular growth leaders are positioned within that index. Then we look at China Internet. We're looking across the board, ladies and gentlemen, some of the areas that had the most froth. Chinese internet stocks, which we don't have any exposure to, also had a very sharp correction right back to the 200-day and have been bouncing and resuming uptrend over the last couple of days. Same holds true for the solar stocks, the IPO index, very important. And ARK Innovation. We all know the ARK ETF has sort of been at the center and the epitome of growth, and they've been at the center of the storm. And that ETF really bottomed, became very oversold Friday morning. So what I wanted to do here is do a quick share of my Bloomberg screen so that I could show what the last 6 to 7 days have looked like. As we all know, last week was a painful week. What we saw was a big meltdown in the NASDAQ. But if you remember from last week's update, what we really thought was that Thursday would mark the beginning of the end of the correction, and that Friday would ultimately define the end of the correction. And what we notice here, this is Friday, where my pointer is right now, ladies and gentlemen. If you looked at your portfolio, what is this, around 9 or 8 or 9 o'clock in the morning, Pacific time, it was not pretty. We ended the day down 1%, but it was far, far worse around 9 o'clock. This, ladies and gentlemen, was the defining bottom in the NASDAQ, at least right now, right? We could certainly be wrong and we could retest the lows, but this was the low. This was right around 11:30 Eastern time, 8:30 Pacific. We had the lows put in. Sharp rally to end the day almost flat from a very, very bad morning and market open. Then Monday came around and we tried to retest. But notice what happened here, ladies and gentlemen. We retested at a low that was higher than the previous low. So when we look at short-term trading conditions, what we're trying to see is when sellers are putting buyers to the test, are buyers holding their ground at higher levels than the previous low? So what we saw here is we had a higher low. And then of course, Monday, or is that yesterday? No, 2 days ago, sorry. We had that, Tuesday, pardon me, we had that sharp rally in the stock market, and our strategies were up I think around 6.5%, correct, Tim?
Yeah, 6.54.
6.54% on Tuesday. Now, the reason why I'm bringing up that term is, remember what we said before, ladies and gentlemen, if you miss the first 10 days, that can have a devastating impact. And we saw that effect on Tuesday, where we were up a lot. Now, does that mean we're not going to have a down day tomorrow or the day after? Of course not. But it's those very, very sharp up days that define the recovery and where we want to participate. We don't want to leave that on the side just so that we can ease our mind. Investing is difficult. Investing requires discipline and requires solid behavioral training in order to realize long-term growth. But this just kind of shows what we've seen here over the last week. And this is kind of, today was also interesting, ladies and gentlemen, from the fact that sellers really tried to push this market down and we kind of ended the day flat, which I actually think is pretty good. Now, does that mean we're going to have rip tomorrow to the upside? I have no idea, but I like the way this looks right now. And so I'm going to go back to our trusty slide deck here and we'll move on here. So the other thing is understanding performance in 2021. We're very early, ladies and gentlemen, 2020, only about two months in. But notice what's happened here. The best performing stocks year to date are down 1.3%. In other words, those high quality secular growth leaders are down 1.3%. And the laggards from last year, in other words, those stocks that are at the center of the COVID storm are up 3.6%. Those junk stocks that we always talk about are up 3.6%. And you can see these are two stocks, we don't own either of them, Tesla versus Exxon. I mean, I think the picture says 1,000 words right there. Exxon is up, Tesla is down. Do we really believe over the next 10 years that we're going to be, the intensity of oil consumption is going up and that we're no longer going to be using electric vehicles? Of course not. And, you know, we tend to think that, now we don't own Tesla. We're not going to be owning Tesla for other reasons, but we don't think that Tesla's run is over by any means. So why are we bringing this up? We're bringing this up, ladies and gentlemen, because one of the things that catches a lot of investors off guard is the hangover trade. What do we mean by the hangover trade? It is so tempting to buy the stocks that did the worst during the previous crisis on the rebound and to hold on to them. So during the global financial crisis, people immediately, once the market bottomed, let's buy the banks. It's a no-brainer, right? We're going to survive. The banks are going to survive. It's a great trade. It's a great trade for a very short-term time period. So we see here the banks collapsed. They were saved by quantitative easing in the Federal Reserve. And this was a very sharp recovery, ladies and gentlemen. We're talking like 50, 60%. But notice what happened. For the next decade, these banks were dead money. The market was going up, other sectors were going up, and the banks did nothing for 10 years and beyond. So why are we bringing this up? Notice what happened. We had the sharp correction during the global financial crisis, this big return for the banks, and then they did nothing. Now, guess what's ripping is Are these the reopened stocks? So in other words, companies with weaker finances have staged the best relative run since 2009. What were the companies with the weakest relative financial with the weakest relative balance sheets in 2009? Well, the banks. What are the companies with the weakest relative balance sheets this time around? The center of the storm COVID stocks. Companies like Carnival Cruise and the other cruise liners and the movie theaters and the airlines, they've all stuffed themselves with debt. Obviously, as the reopen is starting to take place, people have rushed into these stocks. But be wary, because they have so much debt on their balance sheets that will act as a long-term albatross on their ability to make money over the very, very long term. Oh, and by the way, ladies and gentlemen, if interest rates really are going up, do you want to own a company that has low levels of debt, or companies that have a high level of debt that have to refinance at higher interest rates? I think we know the answer to that. We want clean balance sheets.
Yeah, Rob, I think that's a really great point right at the end there, because I think one of the things we saw, right, Q1 on this chart here is weak balance sheet stocks got crushed. You mentioned cruise lines, airlines, a lot of them had to raise debt at really bad interest rates even then, right? So you're seeing this where they're no longer priced for bankruptcy, but as you mentioned, they have to start, refinancing that rate at a higher rate. It's already high, right?
It's already high. It's already there. So Carnival Cruise is getting 10% interest rates in a 0% interest rate environment.
Yeah.
Do you think that business model might be risky? I think it might be. Now, I'm not saying out there to go short cruise liners. It's not a recommendation to buy or sell this stock. But what it is just to try to say, what are the types of companies we're looking for? Why do we need to be careful after a crisis to buy the stocks that were at the center of the previous crisis? Because those companies, generally speaking, either have to raise debt or issue equity, which dilutes existing shareholders to survive. And then they go through about a 5 to 7 year period of balance sheet repair where they cannot reinvest their retained earnings back into the business to generate innovation, to generate market share capture, to generate revenue growth. They're all that money is going toward paying down debt. And that's not what creates shareholder equity value. What does is revenue growth, expanding margins, rising EBITDA, which falls down to the earnings line. That's what we want to pay attention to, ladies and gentlemen. Healthy companies with solid long-term growth prospects. The other thing here is we always want to challenge the narrative, ladies and gentlemen. Inflation. That's been the big boogeyman over the last, over the last month. Inflation. Oh my God. Well, what we saw today was very interesting. There is no inflation. We saw the core CPI came in dramatically under forecast. So I'm going to go ahead and share my Bloomberg screen again to actually look at the CPI data. What we saw here was when we strip out the effect of food and energy, we came in 50% below forecast on a month-over-month basis. So core CPI was up 0.1% relative to 0.2% forecast. That year-over-year number is 1.7%, ladies, or sorry, 1.3%. That is nothing. There is not a whole lot of inflation out there. And so what we saw was, of course, the 10-year yield started to retreat. And that's partly why we saw such a sharp rally yesterday, was we came off these 1.6 levels down toward sitting here right around 1.53%. And when we look at overall national rents, I mean, that really, picture says 1,000 words. Look at rent inflation. It's just dramatically coming down. And now, what's one of the things that can really be holding back inflation here is savings. Savings is inflation's arch nemesis. When people save a lot of money, that tends to tamp down inflation because spending and high demand tend to drive prices upward. Classic supply-demand dynamic. But when Americans are saving more, or just in general, the global economy is saving more, that tends to have a depressed impact on price growth. And so what we see here is a massive spike in savings. It came down and normalized, but notice what's happened, what's happened lately, ladies and gentlemen. That savings rate starting to come back up. Americans have realized, hey, you know what? It's pretty nice to have a lot of savings. It's pretty nice to pay down that debt. Now, are we going to spend more? I think we are. I think that's good for the economy. But are we going to spend to the point where we're going to drive up inflation to an uncontrollable rate? I don't think so. The data doesn't point to that. Now, if the data changes and that situation changes, we'll change and evolve with it. But right now, we have to pay attention to the data. We can't get lost in the media firestorm. We got to stay focused on long-term growth. And I just wanted to remind all of our viewers of the story of secular growth. Over time, we're going to go through zones of overconfidence and zones of self-doubt. But as long as that value line is accruing upward and to the right, at some point, the stock price reflects that overall value. But we have to remember, stocks over the very short term are always in a point of positive or negative momentum. And there's always going to swing back and forth above and below the value line. Very rarely does a stock trade right at the value line. So the key point here, stay focused on the trend. The fundamental trend is your friend. And the last thing, we just wanted to wrap everything up with a credit market check. I'm going to ask a question, Tim. If we think interest rates are on the verge of going up, will that generally be good or bad for junk bonds? Companies that have junk bonds?
Bad.
Yeah. Now Tim sounds like confused and, well, yeah, obvious. That's the kind of the obvious way. It's gonna be bad. And there's a reason why he's reacting that way, because it is bad. It's bad for companies that have a lot of debt. It's bad for the Carnival Cruises of the world, right? If you have to refinance debt at a higher rate, guess what? It's going to strain your business model, and those credit spreads are going to expand upwards. So when credit spreads go up, that's indicative of rising credit risk. Notice what's happened here. Credit markets have done nothing, because at the end of the day, the only rise of inflation that we're going to see is over March, April, and May, when we're just doing a year-over-year comparison over deep trough levels from last year. So the math is going to look distorted, but when we get through that, the real baseline inflation hasn't really changed. And so we have to do our homework. We have to go through, parse through the noise of the media and pay attention to the data. And that's why, when we look at that, inflation is really quite muted, and we don't really see huge catalysts going forward. So overall, what does that mean? That means at the end of the day, we want to stay focused on companies that can grow their long-term enterprise value. Those companies are going to reprice upward as the whole inflation scare, the narrative around ARK Invest and rising 10-year yields, as all that stuff starts to subside, these stocks come back into favor and we resume the uptrend. Credit markets are solid. And again, we say this every week during bull markets, during corrections, during bear markets. Don't get lost in the short-term noise of the market, ladies and gentlemen. It's garbage. It's only going to hurt you in the long term. Stay focused on high quality growth, good companies, good leadership at those companies, good management teams, and you'll make money over the long run. So on behalf of Tim, myself, and the rest of the team here at the LifePro family and your LifePro Asset Management Advisor, thank you so much for your business. Thank you for your discipline. We have been absolutely astounded by how disciplined our investors have been, putting more money to work during corrections, asking the right questions. How should we be reallocating our portfolio during times of corrections and taking advantage of lower prices? That's what we love to see. That's why we're in the business. And if anyone has any questions, please reach out to your advisor, or you can reach out to our home office here in San Diego at 888-543-3776. Thank you again to everyone. Have a fantastic week, and thank you again.